Hey guys, welcome back to the show. Thanks so much for tuning in. My name is Mike, this is my whiteboard, and today we're going to be continuing with our Trader Checklist mini-series, and we're going to talk about the short strangle today. So in the past 2 days, we've covered a short put, we've also covered a short put credit spread, so we kind of weighed the differences between those two strategies. And today we're going to take a more neutral stance with a short strangle, which is really just selling an out-of-the-money put with a out-of-the-money call in conjunction, which creates a neutral profit zone. So let's get right into it, and we'll begin talking about the short strangle and what we like to look for, what sort of environment we ideally want to place this trade in, etc. So when we're looking at the short strangle here, just a quick review, we are selling an out-of-the-money put, which is a put below the stock price, as well as an out-of-the-money call, which is an option that's above the stock price. A call contract is the right to buy 100 shares of stock, so we're on the other side of that when we're selling it. And a put contract is the right to sell 100 shares of stock, and of course if we're selling that option, we're on the other side of that transaction. So naturally, a put contract, if we're selling it, is a bullish strategy, and a call contract that we're selling is a bearish strategy. But when we combine the two, we have the battling directional assumptions between them, but it creates a profit zone because, of course, when we're selling options, we want them to expire out of the money. So as long as the stock price stays in between this range at expiration, we will be able to reap that full profitability and be able to turn that credit we received originally into 100% profit at the end of expiration if that stock price is between our short strikes. So again, this is another strategy that is routed for a credit. We're selling both of these options, and for selling that, we're actually collecting in cash. It's not profit right away because the brokerage knows that to close the position, we have to buy it back. So if I sell this strangle here for $1, if I want to close out of that trade a minute later, I'm going to probably have to buy it back for $1. So you won't see that profit coming right away, although we are collecting that cash right away. So the biggest thing with a short strangle is that it's a delta neutral, undefined risk strategy. And again, we want that stock price to stay between our strikes at expiration. A few key concepts here is that, number one, it's delta neutral. A short put has a positive delta where it is beneficial where the stock price goes up. And again, that's a bullish strategy. And a short call is a negative delta strategy. But if we have both of these options that are pretty equidistant or near around the same delta, so let's say I've got a positive 30 delta for my short put here and a negative 30 delta for my short call. When I have a long delta and a short delta for the same value, both of those deltas will cancel each other out, which gets us close to that delta neutral zero delta. When we have this assumption, we basically don't really know where the stock's going to go. We never really know where the stock's going to go anyways, but in this strategy, we don't have a bias in any way. We don't believe that the stock's going to go up or down. We kind of feel that it's going to stay within this range, or we hope that it's going to stay within this range at expiration, which would be the best case scenario here. When we're looking at the implied volatility environment, just like a short put or a short put spread, any basic strategy where we're selling premium, it's going to be most beneficial in a high implied volatility environment. And I'm going to break down that even further on the next few slides here, but whenever we're looking to sell premium with a basic strategy like this, when we're not really looking into butterfly spreads or ratio spreads, any basic strategy where we just have one contract here and another contract on the other side where we're selling it, a high implied volatility environment is going to be best. But before we get there, let's talk about what can happen when the stock price moves, just like the analysis on the other two strategies from the previous 2 days. So on the next slide, we're going to talk about what happens when the stock price goes up, goes down, or stays the same. And I want to point out a few key concepts when we're looking at this strategy specifically. So if the stock price goes up, I've got these sections here in orange because they're not necessarily bad things. They could turn into a bad scenario, but when the stock price is moving, of course it's going to move regardless. It might come up a little bit or might go down a little bit. So I just want us to be aware of these situations and what happens to our option contracts and why it can potentially be bad if it goes too far to the upside or the downside. And of course, when the stock stays the same, that's going to be our best scenario, which is why I have it highlighted in green. But let's talk about first the stock price going up. So when the stock price goes up, we have to remember that the call option is going to be moving closer to at the money, because if the stock price is moving up, it's getting closer and closer to that strike, which is going to increase the value of the call. If I was long this call, it would be a good thing because I would want to sell that call for a higher value. But since I've sold this call to begin the trade, if the value of that call increases, that's going to be bad for my position because, like I stated in the first few minutes, we have to buy back these options to close the trade. So if I sell a call here and the value of the call increases and I have to buy it back at a higher price, that's going to be bad for my P&L. But if the stock price is going up, the put price is going to decrease because the put option is going to be moving further and further out of the money, because if the stock price is moving up, that just creates more distance from that strike price that we've sold that put on. So like I said originally, these have differing directional assumptions and they're going to act differently as the stock price moves. So when the stock goes up, our call option is going to gain value, which is bad when we're sellers of the option. But our put option is going to lose value because it is moving further and further out of the money. So the big takeaway for this is that if the stock price moves up just a little bit, you will definitely see the call option losing, and you'll probably see the put option in a winning position. But the key is to look at this trade as a whole. If we have a call option that's losing a little bit of money, maybe the stock price is right here, still within our short strikes, and we see the put option winning, then we're probably going to be in close to a zero P&L, maybe a little bit in the red, or maybe if enough time has passed and the stock price has moved just a little bit up, that time has decayed these options enough to put us in a profitable situation regardless. Because at the end of the day, we have to remember that if the stock price is between these strikes at expiration, I'm going to be able to obtain that full profit. So even if the stock goes up just a little bit, we're going to see the call price increase, which is bad, and the put price decrease, which is good. The only situation where we can get into trouble is if the stock price moves past our short strike here on the call side, and that is when we might look at some adjustment strategies. But what happens when the stock stays the same? Well, this is the best case scenario for us because we have that theta decay working for us. We sold both of these options, and if we remember, when we sell options, theta decay is beneficial for us. Theta decay is just the rate of an option's decay over time, all else equal. So we're looking at the decay of these options. So the more time that goes by where the stock price doesn't move at all, both of these options are going to lose money over time, every single day, and that's going to help us buy back this spread for a lower price. So this is the best case scenario here, where both contracts would lose value over time. If the stock price goes down, it's just the opposite from when the stock price goes up. So our put price will increase, which is of course bad since we're sellers of these options. But our call price will decrease, and that's good. So just like when we looked at the stock price going up, if the stock price goes down, our put option is going to move closer and closer to that stock price, which puts it closer at risk to being in the money. But on the flip side, our call option is going to move further and further out of the money. So again, the more time that passes when these movements happen, the better the situation is going to be because of the fact of the theta decay that we have working for us. And the closer we get to expiration, the more probable we'll be able to see that large profit of the total credit we received at expiration. So if the trade moves against us right away, right when we place this trade, we'll probably see a losing situation. But if the stock price is still between these strikes, I'm probably fine with it because I know that if it stays in that range, then I'm going to be profitable in the long run. So what are some tasty trade tips that we look for when we're trading this strategy? Well, we'll talk about those on the next slide here. The very first one is calculating our break-even price. We always want to know where our break-even is. It's always going to be different than our short strikes because of that credit that we're receiving from the beginning of the trade. So the break-even calculation is pretty simple. You just take the total credit that you received from the trade, and when you're looking at the break-even to the downside or the put side, all we do is take the strike and subtract the credit. Because if our put goes in the money, we'll have to buy back that put for a certain value. Our call option would expire out of the money, but we're able to use that credit we received to offset any losses. So if I collected $1 for selling both of these options here, if I've got a put option on, let's say, an 80 strike, and I collected $1, my break even would be at 79 on the downside. The call side, we're actually going to add the credit to the upside risk here. And that's because the call option would be in the money if the stock price was above that option. So whenever we're collecting a credit for a strategy, we're going to be moving our break even to a position that benefits us. So of course, to the downside, it would be subtracting that credit from the strike. And on the call side, it would be adding the credit to the strike. So in the same example, let's say I've got a call strike at 90 and I collected $1 for this trade. If I've got a strike at 90 on the call and I've collected $1, that means my break even is at 91. Because if the stock price is at 91, I would have to buy back my short call for $1 at expiration, which is intrinsic value there. But since I collected that $1, even though I have to pay $1 to close out this call, it's not going to matter because of that $1 I collected. So that's where my break-even price is. Of course, the IV factor is always going to be a big beneficial factor here, and the higher the IV, the better. So in the last 2 episodes of these trader checklist series, I talked about the implied volatility factor and the bell curve of probabilities and the bell curve of option value. So if we remember, the higher the implied volatility when we're looking at that bell curve of value or the bell curve of the probabilities of these options being in the money, the higher IV we have, the wider those probabilities will spread out over the strike prices. The lower the IV we have, the more narrow it gets. So because of that, the higher the IV, the better for 2 reasons. Number 1, if I'm looking to collect $1 for this strategy, a higher IV environment is going to allow me to move my strikes much further away from the stock price because there's going to be value in those farther out options because the probabilities are going to be higher in those options when we're looking at them expiring in the money. So for that reason, if I'm looking to just collect $1, I'll be able to move my strikes much further away. If I'm looking at these same strikes here, I believe I used 80 and 90. If I'm looking at placing a trade on the 80 and 90 strike, a higher implied volatility environment is going to give me a much higher credit than when I compare that to a lower volatility environment. That's because both of these options are going to have a higher probability of expiring in the money in a higher implied volatility environment, because implied volatility is just the implied move of an option's or a stock's price over a certain period of time. So the higher that value is, the more implied movement there is, and therefore the probabilities will increase because of that. But the increase in probabilities will relate to the increase in premium I'm collecting. So in both scenarios there, the higher IV, the better for the strategy. We do look to close this strategy at 50% max profit. And that's just another way to lock in these profits. If we see 50% max profit, the most profit we can make on these premium selling strategies is the credit we received. It's unlike a long strategy or a long naked option strategy where I have unlimited profit. When I'm selling this premium, if I can collect $1 and I'm able to lock in a profit of 50 cents, I'm probably going to lean towards doing that because I only have 50 more cents to make, but I'm holding the same amount of risk. So when I get that risk reward that's not very beneficial to me because I've already reached a healthy value of the max profit that I can receive, I'll look to close it at around 50% max profit. And lastly, our ideal setup, which we've shown in some of our research, is if we can collect around a 20% return on capital. So basically we're just looking at whatever that credit is that we're receiving, dividing that by the buying power reduction required to place the trade in most likely a margin account, we'll be able to get that 20% return on capital in usually a very high IV environment. And if we can place our strikes around that 1 standard deviation level, that's going to give us the highest probability of success and also a very nice P&L if we can reach this ideal setup. But let's wrap all this together with some takeaways for you. The very first takeaway here with a short strangle is that it is a neutral range-bound strategy. So unlike selling just the put or just the call, when we sell those two together, that creates a directional battle between them. We're creating that neutral range where we can be profitable. A high IV environment is best not only because we can move our strikes further away if we're looking for a certain credit amount, but also because if we want to keep our strikes the same, we're able to collect a lot more, which of course moves our break-evens much further away, which is really the key with that. Also, we like to close that trade at 50% max profit because we're looking at that risk-reward scenario. When it goes against us in terms of having too much risk for too little reward, we look to close the trade and just lock in that profit. And again, the ideal setup here is for a 20% return on capital at the 1 standard deviation line. So if I'm looking at an option chain, I would be looking at a 16% probability of being in the money on the put side and a 16% probability of being in the money on the call side. That's a 1 standard deviation range. And if I can get about 20% return on capital while covering that range, that's a great setup for me. And of course, there's going to be a lot of defensive opportunities when we're looking at short strangles, so be sure to check out my other whiteboard, which was 3 adjustments for the short strangle, and I'll include it in the description in the video when I archive this. But we've got Jim Schultz coming up next, so let's get on to that. And again, if you have any questions or feedback, shoot me an email. I'd love to hear it. Shoot it here at support@dough.com or or you can follow me at DoughTraderMike on Twitter. But again, we've got From Theory to Practice coming up, so stay tuned.